Good afternoon, everyone. Welcome to Arabian Drilling's Q3 2023 earnings conference call. I'm Madhu from Al Raji Capital and your host for today's call. From the management, we have Mr. Ghassan, the CEO, Mr. Hubert, the CFO, and Mr. Wright, Treasury and IR Manager. Now I hand over the mic to Mr. Wright to start the proceedings. Mr. Wright, the floor is yours. Please go ahead.
Thank you, Madam. Good afternoon, everyone, and welcome to Arabian Drilling's earnings call for the third quarter of 2023. Our thanks to Al Raji Capital for hosting this call. We have recently announced our Q3 2023 financial results, and the documents are available on our investor relations website. As usual, we must start with a disclaimer, so I invite you to read it at your convenience. I would like to take a moment to introduce our speakers for today's call. First, we will hear from our CEO, Mr. Ghassan Mirdad, who will provide an overview of our performance. Then we'll have our CFO, Mr. Hubert Lafoy, who will take us through the company's financial performance for the third quarter and 9-month period. The agenda for today's session will cover various topics, including our key milestones, a review of our operational and financial performance, including forward-looking guidance. We will then open the floor for your questions. I would like now to hand over to our CEO, Mr. Ghassan Mirdad.
Thank you very much for the introduction, Raed. Assalamu alaikum and heartfelt welcome to all participants joining us for this earnings call today. We'll begin with a brief overview of what happened during the quarter. We achieved a number of important milestones in the third quarter across financial and operational aspects of our business. Starting with operations, rig activity this quarter increased slightly compared to last quarter as our fleet expanded, with 47 operating rigs over a total fleet of 50, which resulted in a utilization rate of 94%. Our non-productive time increased slightly as a result of starting up 3 new jackup with new equipment and crews. On the other hand, our rig efficiency index remained strong with an overall score of 93.5%. Finally, we saw an increase in rig move activity over the quarter with 49 rig moves, bringing the total for the year to date to 128 rig moves. On average, we are always ahead of Aramco KPIs, and for those of you who have been on site, you will appreciate the efforts required to achieve such results on the rig moves. On the safety front, our total recordable injury frequency rate performance experienced a slightly increase. However, it's still 3.5 times lower than the industry standard based on the latest International Association of Drilling Contractors report. I'm also pleased to announce that one of our rigs was selected by our client for a new type of drilling campaign in the north of the country. The rig completed an extra long move of over 2,000 kilometers to drill a geothermal well. This will contribute to our plans to support our client various initiatives that will derive sustainable energy to the kingdom. Moving to the financials highlights, which Hubert will cover in more details. Our Q3 revenue grew 16% quarter on quarter to 920 million SAR, mainly due to the startup of the 3 additional offshore rigs in July. Our EBITDA improved by 17% this quarter and remained at a similar profitability level of around 42 to 43 of the revenue. Our Q3 net income was stable compared to the previous quarter. In spite of the high EBITDA, the bottom line remained in line with the previous quarter due to higher finance cost. We closed this quarter with almost 1.3 billion of available cash, which is lower than Q2 as the cash continues to be deployed to cover the construction of the 10 new unconventional rigs. On the growth front, we made great progress. Our backlog hit all-time record. This quarter increased by more than 65% to 12.7 billion SAR. We are also quite happy with the continuous delivery of our growth strategy. During the IPO roadshow, we told investors to expect a fleet increase of around 20 rigs by 2026. Since then, we have added 15 rigs, which has resulted in almost fulfilling our target in terms of rig additions way ahead of 2026 deadline. And what's coming more on the future? We continue to see good opportunities and further rig demand in the conventional and unconventional space. On the business landscape, we remain bullish on the outlook. In recent months, we have successfully secured 6 billion SAR in new contracts. As previously announced, these contracts comprise of two key components. First, we added 3 billion SAR in firm revenue by winning contracts for 10 new land rigs for the unconventional gas fields. Second, we added another 3 billion SAR linked to Aramco's contract extension, including notable 10-year extension for one of our offshore rigs. These extensions show our ability to cultivate long-term partnership and provide stable, reliable service to our clients. Our 3 offshore rigs operating under 5-year contract have been fully operational since July, and we are delivering on our commitments. To support the unconventional award, we have already commenced the construction of the 10 new rigs, representing a significant investment in our operational capacity. We remain bullish on the market outlook. Aramco is progressing on its ambition expansion plans for their production targets, the development of the unconventional gas. Arabian Drilling is a partner of choice for both of these important plans. All in all, these accomplishments reflect our dedication to growth and operational excellence. We look forward to further significant our position in the market and contribute to the growth of the industry. Going over operational highlights, I mentioned earlier that our backlog reached all-time high, raising from 4.6 billion to 12 billion SAR in Q3, as you can see on the top left chart. The 5.1 billion added in Q3 represents the 6 billion of firm revenue intake, less 900 million of contract revenue recognized in this quarter. With the new awards and extensions, we have continued to strengthen our position with Aramco and entered a brand new market for us with the unconventional. Looking at the bottom left graph, we had 8 rigs rolling off contract in 2023. We managed to renew 7 so far, and 1 contract is expected to sign an extension very soon. The focus on maintaining a high rig efficiency index is the drive to continue renewing contracts successfully in the years to come. Looking at our efficiency, as mentioned earlier, our rig efficiency index remains strong, as you can see in the top left chart. I'm actually proud to announce that Aramco top rigs and rig efficiency index score up to July 2023 were Arabian Drilling rigs. To be clear, this means that one of our land rig and one of our offshore rig were the best for the past 3 years on the rolling average basis. This is an outstanding performance achieved by our team. Moving on the rig moves. In the current quarter, we completed 11 more moves than the previous quarter. Compared to Aramco KPIs, we have saved a total of 34 days of an average of 0.7 days saved per rig move. Out of the 49 moves, only 1 rig move lowered the entire average due to unplanned maintenance. The slight increase in our quarterly non-productive time, as you can see on the bottom left chart, is not unusual. There is always a warm-up period when we start up rigs with new equipment and new crews, compared to a steady state rigs. Our utilization rate rose slightly as we expanded our rig activity with the addition of the 3 more offshore rigs to our fleet in Q3. With that, I will now hand over to Uber to give us an update on the financial highlights.
Thank you, Ghassan. Good afternoon, everyone. Let us start first with the consolidated view. On the top left charts, we have closed the quarter with a revenue of 920 million SAR, representing a 16% increase against last quarter, mainly due to the startup of the 3 new offshore rigs with a contribution of more than 100 million SAR. Our year-on-year comparison tells a similar story with a healthy 27% increase as we enjoyed in 2023 the combined effect of higher rig activity as well as improved day rates, particularly in the offshore segments. Looking at the top right chart, our Q3 EBITDA of 392 million SAR came with a quarter-on-quarter increase of almost 60 million SAR, or 17%. This EBITDA boost is also attributed to the successful offshore rig startup. However, it's worth noting that the contribution of the offshore rigs has been partially offset by higher costs in staff compensation, rig startup cost, and certain one-time G&A costs incurred during the periods. Our year-on-year EBITDA progression of 26% is in line with the revenue progression. Now, moving to the left chart below, our net income has remained stable in spite of higher operating profits due to the increased interest cost. So the main reason for the increase is the accounting treatment related to the interest cost. In Q2, we capitalized circa 20 million SAR of interest cost in connection with the CapEx program of the 3 new offshore rigs. Now, the same did not happen in the current period simply because the rigs started their contract in Q3. Finally, on the CapEx side, we have seen an acceleration of the spending in Q3 of 568 million SAR, primarily attributed to the ongoing constructions of the 10 new unconventional rigs. In the current period, we have spent roughly 375 million SAR on this program, and to date, we have spent approximately 25 to 30% of the total CapEx program for the new 10 unconventional rigs. This significant investment will continue over the next few quarters and is a substantial step forward in our operational expansions. Our 2022 year-to-date CapEx of 926 million included approximately 570 million SAR of acquisition cost associated with 2 of the new offshore rigs. Looking at our segmental reporting, let's focus on the offshore first, on the left side of the slides. So for offshore, we reported a sequential revenue increase close to 120 million SAR, or 39%, in our revenue from 302 million to 490 million SAR, almost all of which is attributable to the 3 startup, as already mentioned. And we now enjoy a 100% utilization rate from our offshore fleets, with 12 units fully operational. On the cost side for the offshore segment, we also witnessed an increase in excess of 60 million SAR during the period, of which 80% is purely attributable to the 3 startups, and the remaining 20% of the cost is mostly coming from employee-related cost as well as share cost allocation. Now, looking on the land segment, our revenue improved slightly by 11 million SAR, mainly due to higher rig move activities. There is no change in rig activities quarter on quarter. On the cost side for the land segment, the sequential increase is circa 30 million SAR, and the increase is split roughly 1/3 for costs related to non-operating rigs, including the startup of the 10 new unconventional rigs, and the remaining 2/3 arising from employee-related costs as well as share cost allocations. Now, the startup costs for the 10 new and conventional rigs will continue to burden the land segment profitability over the next few quarters as we progress with hiring and training the crew for those rigs ahead of any revenue contribution. Moving on with our cash flow and net working capital. Our net cash flow generated from operating activities was 98 million SAR in Q3 against 348 million SAR in Q2. This decline was primarily due to the temporary changes in our net working capital that was partially offset by mobilization fees collected in the quarter. So excluding this timing difference on the net working capital and the one-off mobilization fee collection, which amounted to circa 260 million SAR, or adjusted cash flow or normalized cash flow from operation would have been around 360 million SAR, which is actually a 36% quarter-on-quarter increase on a comparable basis. Now, we closed Q3 with a cash position of roughly 1.3 billion SAR, about 30% lower than last quarter, which included 1.5 billion SAR of cash plus 300 million SAR classified as short-term deposit on the balance sheets. Now, the cash utilization during the period mainly includes 568 million SAR in capex, offset by 300 million SAR redemption of short-term deposits. At the end of Q3, the cash position of 1.3 billion SAR also included 875 million SAR of short-term deposits with maturity of less than 3 months, and therefore they are classified as cash and cash equivalents on the balance sheets. Our net cash flow from financing activity in the quarter was negative 105 million SAR and includes the semi-annual coupon payment from our Sukuk of approximately 75 million SAR. Therefore, it's not really comparable with the previous quarter in Q2. The other component of the finance cost paid during the period relates to the interest portion of the lease liabilities and your regular bank fees and other charges. On net working capital, so now I'm focusing on the slide on the chart, which is on the right side of the slide. You can see we have a sharp increase of a net working capital by more than 500 million during the quarter, and this is mainly due to delayed customer collection, which spilled over into Q4 2023, plus the impact of the 3 new rigs. Now, this delay collection are just a timing difference in our receivable position and does not reflect any exposure arising from collectability or creditworthiness. Actually, much of the receivable were actually collected and cleared shortly after the quarter end. Finally, looking at our net debt and leverage ratio, so we have increased our net debt position by 58%, which is in most part due to the utilization of our cash to fuel our growth capex as previously indicated. So quarter on quarter, there is no change in our total borrowing position, and our gross debt remains at roughly 2.5 billion SAR, which is made of 2 billion SAR from our Sukuk and 500 million SAR from a bank loan that was drawn in Q4 of 2022. Going forward, we anticipate our net debt position to further increase over the next quarters as we continue funding our capex program. We also expect to draw on an additional bank facility, possibly before year ends. Following our cash utilization, our leverage ratio net debt to EBITDA, which is on the right side of the slides, rose from 0.7 in Q2 to 1 in Q3, and we expect this trend will continue over the next few quarters for the reason I have already mentioned. With respect to the guidance, we have no particular change in our guidance. For full year 2023, we see our revenue in the range of 3.3 to 3.5 billion. Our capex guidance remain unchanged as well and will remains around 2.2 to 2.4 billion SAR. One update on the dividends, the ordinary general assembly that took place on the 1st of November approved a total payout of 225 million SAR, which is equivalent to 2.53 SAR per share, and the dividend is expected to be paid by mid-November. This concludes my section, and I will now hand it back over to Ghassan.
Thank you, Hubert. As we wrap up this quarter, I would like to reaffirm the 4 key pillars of our investment proposition. We are the national drilling champion and taking full advantage of the opportunities in this attractive market. We are growing our fleet and our reach to be at the forefront of unconventional and eco-friendly initiatives that supports Vision 2030. Our operational excellence differentiates us with our clients, and we are investing to maintain the highest industry standards. I'm proud to be supported by an exceptional leadership team and an industry shareholders that are aligned with our long-term operational success. We are delivering on our growth commitment ahead of schedule and are putting together a structure to deliver both financially and operationally. Our Saudi-focused backlog provides clear midterm visibility with more upside potential. Finally, we are committed to deliver total shareholder return. Dividends payout will continue to be considered subject to prudent leverage limits as we invest in our future. Healthy cash flows and financial discipline will ensure the sustainability of these returns and provide shareholders with confidence. Now is an exciting time to be investing in our sector. We have already achieved 75% of our 2026 growth target in 1 year and are excited about the opportunities ahead. We are just starting, and I look forward to continue sharing updates on our progress with you regularly. I will now hand over to Mudin Abbas from Riyadh Capital for the Q&A session. Thank you.
Thank you, Mr. Ghassan and Mr. Hobart, for the insights. Before we begin the Q&A, quick reminder, you can ask by clicking on the hand raise button or post your question in the chat box. First question is from the line of Ricardo. Ricardo, could you unmute yourself and go ahead? Ricardo, we can't hear you. I have sent you the request to unmute yourself. Could you unmute yourself and go ahead?
Hear me now?
Yes, I can. We can hear you now.
Apologies. So, good afternoon, Ghassan, Hubert, Rad. Thanks so much for taking my questions. A couple questions on my side. Actually, 3 of them. The first one is related to the capex. I know it might still be a little bit early to look at capex for next year, but just in terms of the direction, when you think about the capex still to be deployed on your growth plan, and assuming that you don't have any capex related to the offshore, just like you had for 2023, how should we think about capex in 2024 compared to 2023? The second question, also related to the 10 rigs, and Hubert, please correct me if I'm wrong, but I understand that you have already deployed about 25 to 30% of that capex. So just in terms of the orders, what's the latest status on that? How many of the rigs have you already ordered, or all of them have already been placed? And then just on the third question, actually, if you can go ahead with those 2, please, and then I come back for the third question. Thank you.
Okay. You want to start or you want to? Okay, fine. So, I mean, on the capex plan for 2024, so look, I mean, at the end, I mean, we are finalizing our budget, and at this point in time, you know, we have to present the plan of 2024 to the board. So, you know, we're not in a position where we can give any guidance. Though, what I would say is that I mean, there is going to be a big chunk of the 10 new unconventional rigs that's going to spill over 2024, and that's already capex that is committed, right? So definitely we will see. We expect to see another heavy year in capex in 2024, just because we need to, you know, finalize the commitment that we have placed today. I think there was a question on the delivery plan for the.
So I mean, we placed the orders for the 10 rigs. So they're all in motion. I mean, I personally visited China. We have some team there in China to make sure that we are on time. We deliver on our commitments as we usually do with Saudi Aramco. And things are just, the motion is going. And as mentioned by Hubert, part of the capex will be this year, and a big chunk will be next year.
Yes.
Okay, thank you. And then just the final question related to the potential regional expansion or M&As across the region. Have you any updates on that front?
What we see, I mean, going forward, I mean, unconventional still, there is room to grow in the unconventional. There is room to grow in the conventional, and as well, there is room to grow out of Saudi. And all these three are in the air as we speak. So we just have to look which opportunity comes first and which one has better returns to the shareholders that we'll go with. But all three are up for grab.
Okay, that's very clear. Thank you.
Thank you. Next question is from the line of Faisal. Faisal, could you unmute yourself, mention your company name and go ahead.
Thank you for the opportunity to ask questions. This is Faisal Azmi from Goldman. Just two questions on my end. Just when thinking about obviously the unconventional opportunity in the kingdom, during the IPO process, obviously you've mentioned that Jafurah by itself could require between 80 to 100 rigs. I guess maybe the question that I have, maybe in the kind of like from a medium-term perspective, where do you see the potential number of rigs that you will be able to capture from those 80 to 90, and how should we think about the phasing here within the next maybe 5 years? Do you envision yourself adding another 10 within the next 5-year period, or do you actually see that the potential is higher at this stage? Maybe if you can kind of just maybe give us some color in terms of how we should think about those 80 to 100 rigs relating to Jafurah over the next over the medium term, and how do you envision the progress taking place there? That's my first question, and then just my second question is as kind of just to add to Ricardo's comments. When thinking about next year in terms of free cash flow generation, as you kind of ramp up operations, your capex comes down. Do you see room for the dividend being higher than the payout policy, or do you think you're going to stick to the payout policy at this stage, regardless of where your free cash flows come at? Thank you.
So I'll take the first one, and then you can take the second one. So, Assalamu alaikum, Faisal. So, I mean, unconventional is the second wave of growth in Saudi, and we have to play an important role there. And that's what happened in the first, the tender that we took 10 out of 13. Now, the thing is, we're not playing the market share game, because then, we're going to have to drop prices, and that's what we want to do. We will participate. It's important for us. The more volume you have, you can have economy of scale in the unconventional. So it's key, it's important for us, and it's the growth that we're going to see in Saudi. So we'll participate, but we cannot put a number on it because we just don't know how fast the tenders will come, and how is the having more market or more rigs or 10 or more than 10 rigs, how much will it affect your pricing? So it all depends on each tender when it comes through. But we will participate on the coming tenders.
Yeah, I mean, on the dividend, Faisal, I would say that I think it's, we see it as important that, we return values to the shareholders. Saying so, we always need to balance that depending on where we are in the growth cycle and where we are in the capex investment. So we will consider a dividend payment, and we will balance that with where we stand on the leverage ratio. We want to remain moderately leveraged. So these are all decisions that we'll put in front of the board, and at the end of the day, the board will make the call.
I hope that is clear, Mr. Faisal. If you have a follow-up, you can come back in the queue. Next question is from the line of Abdul Rahman. Abdul Rahman, could you unmute yourself and go ahead? Abdul Rahman, could you go ahead? We still can't hear you. Could you unmute yourself? I have sent a request to unmute.
Hi, can you hear me?
Yeah, now, yes.
Yes, sorry about that. This is Abdurrahman Labikan from Jadwa Investments. I just have a few questions from my end. Regarding the increased costs quarter over quarter, could you give us an idea on what portion of these costs are essentially sticky in nature, and what portion can we expect them to go down with the addition of the new rigs and the full startup of them during this quarter?
Okay.
So I'll cover and then you can add that. So one cost we mentioned in our last quarter earnings call, with the 10 rigs addition to the fleet that's going to come, next year, you're talking about, more than 10% of headcount addition. And you're adding them now. I mean, we're adding almost, shy of 1,000 employees. We're adding them now to make sure they're, up to speed, trained, certified to be deployed when the rigs come. So this is a cost that was not planned, that because we won the tender, the cost is hitting us now with no revenue. So you'll see this in the next, couple of quarters till we have the rigs, starting up and operational. That's one cost. The other cost that we see is, as mentioned in my presentation, 75% of the 2026 plan is actually kind of achieved between this year and next year. So the operating model, so we're going through a transformation to assure that we are, we can handle this growth that is fast. So there is a bit of cost on the transformation to look at all of our support functions, our operation, that to handle this growth that was supposed to be up by 2026, and it's happening in a very, very fast pace. So these are the two kind of costs. I don't know if I missed anything.
No, I think Hassan, you said it right. I mean, the thing is that between now and when we start contributing, when the revenue contribution starts for the 10 new unconventional rigs, which is going to be in Q3 of next year, there's going to be a lot of costs that are going to be hit us that that's going to come and are not are in preparation of the growth. So it's not it's not easy to say that there are some costs that will switch off from one quarter on a quarter. I mean, I think that we won't see it's going to be probably difficult to see a normalized cost structure until we have delivered on all the startup of the 10 new unconventional rigs. Now, saying so, it is true that we have incurred a little bit of one-off cost in this during this quarter related to this transformation journey that Ghassan just mentioned about how we become more efficient, how we care about the growth, how all the compliance costs as well that we've seen since we're a publicly listed company. So these are all things that we have seen this year and we didn't have next year. But I think that we will have to wait until the second half of 2024 to see a normalized cost structure, having put behind us all the growth milestone that we're seeing right now.
That's very clear. And just another question on the rig moves. We've noticed in the financials that the mobilization revenues have increased quite significantly year over year. It came out around 26.5 million compared to 1 million last year, the same quarter last year. Is that directly related to the amount of rig moves during the quarter?
So I think, sorry, you're referring to the rig move year on year, correct? The rig move revenue contribution, yeah. Okay. I mean, the rig move, I mean, maybe I can start and then you can come. I mean, the rig move, we don't really control the rig move because it remains at the discretion of the clients to decide when and where the rig are going to move, what distance they're going to be covering, etc., etc. So we might have, one extra long rig move that makes the difference. I'm thinking also last year what happened is that we have a couple of rigs that were suspended, a couple of land rigs that were suspended that went back to work. When you put those rigs back to work, then you have a rig move of a few hundred kilometers. So that would be also one explanation.
So just to explain what Uber is trying to say. So today, when you drill a well, the well can take 1 month, can take 3 months. So the assumption of the rig move that's going to happen this month or next quarter, it all depends on the type of well that the client wants to drill, which we don't have access to ahead of time. This is one. Number two is when you move, you can move, 5 kilometers, you can move 300 kilometers, or the one big move that we had, recently, which is 200 kilometers. So all of this impacts the revenue of the rig move. So it's not about efficiency or anything. It's just how the client, how many he moves the rigs, depending on how long the well stays drilling, and as well, where is the next well, which these things we can't plan ahead, before.
The one thing which is important and we keep our eye on is the fact that we always are ahead of Aramco KPI in terms of rig move. I mean, Aramco KPI will give you, okay, for that particular rig move, it should take no more than X number of days, and we always come ahead of that KPI. So this is the one thing that we keep our eye on, more than the variation in the rig move, which is something at purely at plan's discretion.
Is it clear?
Yeah, that's very clear. I appreciate it. And just one final question from my end. Are there any new tenders under discussion, either on the onshore or offshore segment?
So the offshore, the wave of growth of offshore is done. Saudi Aramco have already contracted all the rigs that they wanted. So no more on the offshore. However, the onshore is the one that we're seeing more, especially unconventional. So there is a tender as we speak going on as we speak with the unconventional.
I see. And will it be in terms of size like as significant as the previous unconventional tender, or will it be more broken up into smaller tenders?
I mean, the one that's coming is for 10 rigs, but more and more will come. But it's coming in chunks, not coming full big tenders.
I think we have already indicated. We expect the unconventional tenders to come in waves, right? Yeah. So this is exactly what is happening.
I see. That's very clear. Much appreciated.
Thank you. Next question is from the line of Zohaib. Zohaib, could you unmute yourself, mention your company name, and go ahead? Zohaib, we can't hear you. Could you unmute yourself? Hello, Zohaib.
Hello?
Yes, we can hear you. Zohaib, please go ahead. We can't hear you. Could you check your audio, please?
Is it okay now?
Yeah, that's okay.
Yes.
Thank you for the presentation, gentlemen. I've got two quick questions. Firstly, the G&A has increased from last year. So this increase, is this what you're relating to with the new hirings for the 10 new rigs? This is where this new hirings are being accounted for? And second is on the other segment, there was a 6.5 million loss there. Could you tell us what was the rationale? Thank you.
So the G&A does not include the headcount increase that goes under the compensation. It's more on the full transformation that we have to go through to make sure that we're ready for the growth that came faster than anticipated earlier. So there is a full revamp of all of our support functions and operation, HSE, supply chain, all of the departments to assure that we are ready for this growth, and hopefully when we grow as well more, we need to make sure that the systems are ready to handle that. Anything else?
No. I just want to say that, I mean, you have to realize that the company, the way it was a year ago, is nothing like the company it is now. I mean, it has gone through a transformation change, and what we mentioned about this transformation journey, the revamping, the upgrading of the operating system, how we handle the growth, how we handle becoming a public listed company. So it came with a number of costs. Some of them are just one-off costs on some specific projects. But I'm thinking about looking at all the how to upgrade the support functions, the HSE, the Thailand,
even the cost of related to governance as well played a role as well.
Yeah, exactly. I mean, just the cost of governance.
You're not listed, and now you're listed.
Exactly. So we have had a number of costs, including the upgrading the ERP, etc. So there are a number of things that we have included this year, which were not on the agenda last year, simply because we were not a publicly listed company and we didn't have all this growth coming with us. So it's really a different company. Now, the thing that I would like to remind is that at the end of the day, our G&A is still less than 6% of the revenue. So it's still, we look at the G&A, but just to put into perspective, our G&A is currently less than 6% of the revenue. So we are growing. The revenue has been growing. The G&A has been growing. There has been a couple of one-off costs, but this is just for us to accommodate the growth.
And there was another question, no?
Yeah, there was another question. Sorry, on the cost. It was on the cost of
6 million
on the offshore. Can you repeat what you
Others,
mentioned?
others, 6.5 million loss in others.
Yeah, I think.
What?
I think this relates to the fact that we did a retirement of one particular asset that came with an NDV of 5+ million. So this is something that this is a one-off asset retirement that hit us in the quarter.
Okay, just a follow up on the G&A. So what do you think is a fair like percentage of revenue, for the G&A? I mean, you said it's about 6% for the quarter. What do you think would be a fair area for this item?
I mean, I think now with the transformation, I don't think we can give a number now, but I think once we have the transformation to give us exactly where do we stand and what is needed for the growth. Because, I mean, we're just literally adding, 15. We just added 5 and now going for another 10.
Yeah.
And there's more tender to come. Let's decide if, we want to move out. So there is a lot of things that there is a lot of things in the air that we're trying to kind of nail to make sure that we're efficient. And that's why this cost is coming to us.
So, I would have the same answer that I had before in terms of the cost structure, what is permanent cost, what is one-off cost, etc. I think that, as Ghassan said, there are so many moving pieces in the G&A and the organization and how we want to operate, etc. That it's kind of I think we're better waiting until the second half of 2024 until we have normalized all the ongoing projects. Some of them are really key projects. Some of them are going to deeply transform the way we operate and the company. So I think it's better we wait until we have a normalized cost structure in the second half of 2024 so that we can put an actual target number on where we want to.
Yes. I mean, it's very early to say right now. We're slicing and dicing and how we can have the structure set up and how we're going to operate and the operating model. So it's going to be very premature to give a number now, but I think, by the start of H2, maybe at least we have some kind of visibility.
Okay, sounds good. Thank you.
Thank you. Just a reminder to the participants, if they have a question, they can click on the hand raise button or post it in the Q&A or chat box. At the moment, we do not have a question through hand raise button. Okay, there is one from Jack. Jack, could you unmute yourself and go ahead, please?
So Jaco here from Granular Capital. Can you hear me?
Yeah.
Hi guys, thanks a lot for the presentation. Just wanted to check on growth and where it's coming from. You mentioned really growth from here is in unconventional. You touched on it before. You thought the kingdom was satisfied in terms of offshore rigs. Can I just ask for a clarification there? Is that satisfied in the sense that all the tenders outstanding have been filled and you don't expect any more? Or do they have all the rigs they need for MSC 13 by 2027, as far as you know?
No, so you're right on the first point. So they have awarded all of the contract that was out already. So every company or whoever is awarded knows the contract, and either they deployed. So I think we are one of the first rig contractor who actually delivered on their commitment. And others just whoever needs to just getting the rigs onto operation. So the awards are done, but they're not all in country yet.
Understood. And then do you think that's all the tenders required for MSC 13 by 2027, or you expect more tenders on top of the ones that have already been completed?
I mean, knowing Aramco's efficiency and the way they run things, I believe that they tendered what they need to achieve the objectives.
Okay, helpful. Thank you.
If anyone has a follow-up or want to ask a question for the first time can click on the hand raise button. Zohaib, I can still see your hand being raised. If you have a follow-up, could you lower your hand and click on it again? Zohaib, if you have a follow-up, please go ahead.
No, thank you. I don't. I just load mine.
Okay, thank you. At the moment, we do not have any questions. If anyone wants to ask a question, please click on the hand raise button or post their question in the Q&A or chat box. Let's give participants a minute or so. We have a follow-up from Abdul Rahman. Abdul Rahman, please go ahead. Abdul Rahman, we cannot hear you. Yes, we can hear you now.
Okay, I just have two quick questions regarding for the unconventional segment. Where should we be, in comparison to conventional, where should we see the margins? Are the margins lower in the unconventional compared to conventional? And the second question regarding the 10 unconventional rigs. We know that will come next year, but in which I know it will be a gradual process, but how should we look into it? Is it the majority will come in the third quarter or the fourth quarter where we could see it fully operational?
So it will come end of Q2, early Q3. But I mean, from a revenue perspective, I would say Q3. You can assume Q3 that's the time they will generate revenue.
Yes. I think there was a question on the margin.
On the margins. I mean, for now, and feel free to correct me, but what we're assuming is the same as a conventional rig, because we're just entering. This is a new, as much as we say it's Saudi Aramco, but the unconventional is like going to another company. It's like you're diversifying your portfolio. So we're just entering to this unconventional skidding rigs. And what the assumptions we had was a normal margin. Now with you can have economy of scale to improve, but today yet to be proven once we start.
Yeah, no, exactly. I mean, we haven't factored. I mean, we believe that there are some synergies coming from operating 10 unconventional rigs, but it's just that we have never tested the system, so we wait before we wait to see what those synergy. How we can generate synergies, etc. So we have remained prudent and basically assumed that the level of profitability will be in line with what we have in our land segments.
I hope that is clear, Abdul Rahman. If you have a follow-up, please go ahead.
No, that's answered. Thank you so much, gentlemen.
Thank you.
You're welcome.
We do not have a question at the moment.
I'm happy to see that everybody's clear. A lot of questions on the G&A. I mean, if there's no more questions, I can do a closing remark and.
Yeah, I believe, Mr. Ghassan, there are no more questions. So back to you for any closing remarks.
So I would just want to thank everyone for joining us today to earnings call. I think we have really exciting times. I mean, as I mentioned, we're growing faster than planned in the roadshow. So we're very excited. The whole organization is very excited with embarking on this transformation. We're seeing a lot of benefits that we're going to see going forward. As mentioned, the next couple of quarters we'll see a bit of this cost because the rigs are not arriving yet. So there is no revenue against the hiring that we're having today, and that we'll see. But I tell you, it's very exciting. The growth is upfront, and even though we did 75%, doesn't mean we're going to stop. I mean, still there is huge opportunities of growth that we're trying to look at. Thank you very much for your time. I appreciate the questions, and we hope we answered your question. If you need any other questions further, going forward, feel free to reach out to our investor relation portal, and we'll get back to you. Thank you very much, and have a good night.
Thank you everyone for joining the call. With this, we end the call. Have a good day.
Thank you.
Thank you.